In 2023 and 2023, the central banks worldwide purchased an astonishing 2,000 tons of gold. This marks the largest two-year acquisition since 1950. By the end of the first 3 quarters of 2024, projecting over 1,000 tons by the end of the year, all hoarding gold as if it is the last safe asset available. No! The fact that these are not typical retail investors makes this even more alarming. Coups from fleeting online trends or chase assets because of price surges. No! Central banks have access to intelligence far beyond what's available to you or me. They consult economic specialists versed in historical currency failures and receive strategic insights from intelligence agencies on international plans. Right. When nations with this level of intelligence all start acquiring the same asset. This is the very tactic used by Roosevelt in 1933. This video will reveal what central banks know that you don't, and the specific strategies they employ to brace for what might be the biggest wealth shift in recent history. Most crucially, it will outline what you should do to prepare before it's too late. Once this shift occurs, once gold is repriced and the dollar plummets, it's irreversible. You can either align yourself with the central banks or risk losing everything by holding on to devalued dollars. Let's delve into which side is the right one to be on. Starting with the numbers, the intensity of this gold buying spree is unparalleled, which keeps track of central bank gold purchases. Reports that they bought 1,036 tons in 2020, and as of the third quarter of 2024, the fourth quarter is on track to lift this year's total above 1,000 tons once more. That's 3 successive years of purchases exceeding 1,000 tons. The previous peak for annual central bank gold purchases was 656 tons in 2018. Prior to that, you'd have to look back to 1950 for such extensive buying. We're navigating through unprecedented times. But it's not just about how much is being purchased. It's also about who's doing the buying and their motivations. In November 2023 alone, the People's Bank of China added 62 tons of gold. They consistently reported purchases for 18 months. But because they intend to keep their accumulation hidden, analysts estimate China has added between 300 and 500 tons to their official reserves over the last 2 years. However, that's only the official count reported to the International Monetary Fund (IMF). China also employs state-owned enterprises to purchase gold via the State Administration of Foreign Exchange and various investment entities that do not report to the World Gold Council. China has likely amassed between 1,000 and 2,000 tons of gold since 2022, and they are still at it. China foresees the inevitable collapse of the dollar. Believing that the nation with the most gold would prevail, despite severe economic sanctions, they continued acquisitions in both 2023 and 2024. Or perhaps their buying spree is precisely because of these sanctions. Russia witnessed $300 billion in its dollar assets being frozen by the West. Assets they believed were secure in Western banks, and securities vanished overnight. Imagine any other country witnessing this. China, for example, holds over $1 trillion in U.S. What stops the U.S. from breathing Chinese assets in a Taiwan conflict? Thus, what have central banks worldwide learned from Russia's experience? I dare you! Avoid dollar assets that the U.S. can take away. Instead, hold on to something untouchable. Physical gold stored in Beijing, Moscow, or New Delhi cannot be frozen, seized, or sanctioned. Russia officially holds 2,132 tons of gold, and for about 25% of their total reserves, the highest percentage of any major economy. For comparison, the U.S. holds 23% of its reserves in gold based on official valuation. Russia's greater exposure to gold in America is a deliberate strategy. Russia anticipates what's coming more keenly than perhaps any other nation. They've experienced the Soviet Union's collapse, witnessed the ruble turn worthless in 1991, and have first-hand experience with Western financial warfare. They aren't purchasing gold because they anticipate a price surge. Rather, they are preparing for a world where dollars lose value and gold becomes the sole meaningful reserve asset. India, too, has been steadily increasing its reserves. The Reserve Bank of India added 33 and 41 tons, maintaining regular purchases every quarter. This steady accumulation has resulted in India holding 801 tons officially. What many don't realize is that Indian households own more gold than any government worldwide. Estimates suggest that Indian families hold between 25,000 to 30,000 tons of gold privately. That's more than the U.S. government, China, or all Western central banks combined. When considering both public and private holdings, India owns more gold than any other nation. India's past is marked by currency collapses. The rupee has been devalued multiple times. Both Indian families and the central bank understand that when currencies fail, gold remains steadfast. This knowledge, passed down through generations, is proving correct now. Poland's national bank bought 122 to 2023. A notable amount for a country of Poland's size, increasing its reserves by 57% from 229 tons in 2021 to 359 tons by the end of 2021. The governor of the National Bank of Poland has publicly declared gold as the ultimate safe asset, asserting that Poland is preparing for a more unstable global monetary system. indicating Poland's anticipation of a less stable global monetary system. A clear indicator they are preparing for the dollar's collapse. Turkey, too, is heavily investing in gold. The central bank of Turkey added 160 tons in 23, a move driven by years of currency crises. The lira has devalued considerably against the dollar, with inflation hitting 85% in 2022. Living through an ongoing currency collapse means buying gold is a necessity. Turkey's central bank is preparing for even worse conditions. The Monetary Authority of Singapore has been covertly increasing its gold reserves. And while they don't release monthly figures like some nations, the IMF data suggests significant acquisitions. Singapore manages its reserves with a higher level of sophistication than most countries. If Singapore is buying gold, it's a calculated move. They foresee something on the horizon, and historically, Singapore avoids financial missteps. All these gold purchases share a common thread. Each central bank is preparing for the same eventuality, the decline of the dollar's dominance. They are bracing for a collapse of the current monetary framework and transitioning towards whatever the future holds. UK! They don't know precisely what the new system will entail, perhaps a gold-backed BRICS currency. However, they do know one thing, it will not solely be based on the dollar. During the transition from the current to a new system, gold remains the only universally accepted asset. Trading currencies like yuan for rubles is complex. Currency swaps are challenging, exchange rates vary, and political relationships play a role. This is why central banks are procuring it at levels unseen in 73 years. They're preparing for a shift in reserve currency. This transition is being expedited by what many overlook. For decades, the U.S. has leveraged the dollar's reserve status to wield power and impeded participation in global trade. This held when alternatives were absent and every country needed dollars. They are building alternate systems and fortifying them with gold. Here's what's happening that mainstream media might not disclose. In South Africa, how they've been developing a gold-backed currency since 2020. It's an official policy by governments representing 40% of the world's population and 25% of global GDP. The group extended by inviting countries like Argentina. The BRICS nations are constructing a parallel financial framework. Each BRICS country contributes gold to a reserve fund backing a new currency for international trade among members. When China purchases oil from Russia, they settle in this gold-backed BRICS currency. When India buys goods from Brazil, they use it. It's settled in the same current sino-dollars involved. This disrupts the petrodollar system that has underpinned U.S. power since 1974. Saudi Arabia would price oil in dollars exclusively. This created a constant demand for dollars, allowing the U.S. to print them limitlessly without causing immediate inflation because they were absorbed globally. If Saudi Arabia begins accepting yuan or the BRICS currency for oil, and trillions of dollars held overseas rush back to the U.S., Saudi Arabia completed its first oil sale to China in yuan. That was the initial crack in the petrodollar foundation. Russia and India have traded in rubles and rupees. ASEAN countries are crafting a regional payment structure that bypasses the dollar. Each of these reduces dollar usage, propelling us closer to its collapse. This is why central banks are buying gold. They're aware that the BRICS gold-backed currency is coming, poised to immediately challenge the dollar. Nations weary of U.S. financial hegemony will have alternative they'll utilize. Here's how this scenario could devalue the dollar and erase U.S. debt. Casing a more sophisticated strategy. Her U.S. debt is $37 trillion, with a debt-to-GDP ratio of 32%. The annual interest alone is $1.2 trillion, surpassing defense spending. This debt is insurmountable through conventional means. You can't tax your way out of a 130% debt-to-GDP ratio. Nor can you grow your way out when debt outpaces the economy's growth. Spending cuts won't suffice when interest alone consumes 5% of GDP. Yet overt money printing would incite panic. Instead, you need an approach that outwardly strengthens yet covertly weakens the dollar. Strategy mirrors Roosevelt's 1933 approach and is poised for a comeback. The U.S. officially holds 8,130 tons of gold, roughly 261 million ounces. At current prices of around $2,700 per ounce, these reserves are worth $75 billion. They are valued at $42 per ounce at statutory price, set in 1970. The U.S. gold reserves are worth only $11 billion. The U.S. could announce a partial gold backing for the dollar, not a full gold standard where each dollar is exchangeable for gold, but a system where a percentage is backed by gold reserves. To genuinely back the dollar, you need a sufficient gold-to-money supply ratio. While current gold holdings amount to $500 billion, and mere 3.4% backing insufficient for credibility. Revaluing gold from $42,000 to $20,000 per ounce on the books would transform these reserves to $5.2 trillion, enabling the U.S. to market the dollar as gold-backed and project financial responsibility. This revaluation would escalate gold's price by 50 times its statutory value, implicitly devaluing the dollar by 87% relative to gold. Since gold's price would leap from $20,000 to $20,000, dollar would lose 87% of its value relative to gold, translating to a loss against all commodities food. The government's $37 trillion debt is in dollars, which now hold 87% less real value. The real debt burden plummeted from $37 trillion to $4.8 trillion, effectively erasing $32 trillion without repayment, or merely by devaluing the currency it's calculated in. This stealthily transfers wealth from creditors and those holding dollars to the government, minimizing debt through currency debasement. And this is the strategy that central banks predict, prompting their gold buying before revaluation occurs. Historically, this strategy was proven effective. The U.S. faced soaring debts post-World War I and the Great Depression, with a 40% debt-to-GDP ratio and escalating deflation. Things were collapsing, unemployment was at 25%, and the economy was in disarray. Roosevelt, requiring a remedy, opted for gold revaluation. It became illegal for Americans to own gold, compelling them to exchange it with the government at $20.27 per ounce. This was the official rate fixed since 1879. Most complied, receiving dollars for gold. Rock! Roosevelt raised the price to $35 per ounce, a 69% hike. This move increased U.S. gold reserves value from $4 billion to $6.8 billion, creating $2.8 billion in value from thin air. Saw inflation raise prices and wages nominally but not in real terms. The debt-to-GDP ratio dropped from 40% to 25%, but by inflating it away through currency debasement under the guise of gold revaluation. Americans who relinquished gold at 2067 and saw it revalued to 35 lost 40% purchasing power. They couldn't repurchase gold at the new rate, as owning gold remained illegal until 1974, leaving them with devalued dollars while the government used their gold for debt reduction. Central banks know this history and are positioning accordingly. Buying gold as Roosevelt's strategy readies for reuse will be at not at 35 per ounce this time. Central banks have 3 intelligence sites that remain unseen by the public, signaling their gold purchasing strategy as one to heed. They have real-time insight into capital flows. They monitor foreign investments and portfolio movements, observing which nations buy or sell U.S. oil. Over the past 3 years, they've observed a significant shift away from dollar assets. The dollar share of global reserves fell from 61% in 2020 to 58% by 2024, a 3 percentage point each, translating into hundreds of billions moving from dollar assets to euros. Central banks are reducing dollar exposure due to the U.S.'s insurmountable $37 trillion debt. Second, they access classified geopolitical intelligence. The People's Bank of China is aware of the military's Taiwan conflict timeline, knowing which countries support or oppose China. They understand potential conflict implications for dollar assets. Institutions like the Federal Reserve and the Bank of Russia receive NSA and FSB intelligence, allowing them to foresee known public threats. The prominent threat is the dollar's weaponization. U.S. has frozen $300 billion in Russian assets, setting a precedent that alarms nations like China and India. They understand that significant dollar reserves could be seized if political tensions arise, prompting asset relocation to something untouchable by the U.S. Third, they possess superior economic data. While the official U.S. inflation rate is reported as 3.2% by Q4 2024, tracking actual price shifts across commodities, M2 money supply grew by 40% from February 2020 to 2022. This money remains in circulation and will manifest as inflation, reaching beyond the consumer price index because the government manipulates these calculations. Hooray! Central banks anticipate significant inflation, potentially 10% or 20% or more when crises force further money printing, and look to gold as the sole asset defending purchasing power against inflation. Pattern consistent throughout 5,000 years of history. Phase 1 from 2024 to mid-2025 is marked by final accumulation. Central banks are acquiring gold rapidly but cautiously to avoid light surges, using diverse channels such as direct mine purchases and intermediaries, or quietly buying from other central banks, aiming to maximize holdings pre-revaluation, equating to $86 billion spent on gold yearly, while auto-floating U.S. Treasuries over $500 billion were sold by foreign central banks in 2022 and 2023. Phase 2, stretching from mid-2025 to 2026, involves the announcement revealing that member nations had deposited vast gold reserves into a collective fund to back this new trade currency. Initial adoption will be gradually secured by bilateral deals like China-Russia oil or Saudi-China oil. Countries fatigued by dollar dominance will turn to this alternative nations like Iran, along with neutral countries like Malaysia and Indonesia. A significant portion of international trade might veer from dollar settlement, reducing demand by trillions and weakening the dollar. Phase 3, spanning 2028 ushers out through 2028, ushers in crisis and revaluation, compelling a U.S. response. As the dollar erodes and inflation surges, the Federal Reserve and Treasury will implement the gold revaluation strategy, revaluating gold from $42,000 to $20,000 per ounce on U.S. balance sheets. This generates the illusion of substantial reserves backing the dollar, but in reality, dollar savings lose 87% of purchasing power. Central banks gold purchased at 2,000 or 2,500 per ounce escalate to 20,000. China's 2,000 tons of undisclosed gold acquisitions leap in value from $54 billion to $120 at 20,000 per ounce. Russia's reserves soar from $63 billion to $1 trillion, resulting in astronomical profits by positioning ahead of revaluation. All countries relying on dollars face ruin, marking a wealth shift from dollar to gold holders. It's a question when considering central bank diversification away from... Why not choose stocks, real estate, Bitcoin, or other currencies? Treasuries depend on government repayment. Hey. Overseas real estate hinges on local legal protection. Bitcoin depends on blockchain security potentially compromised by a 51% attack, bans, or internet failure. Its value is signed for thousands of years across civilizations, unaffected by government actions or company failures, immune from court rulings or cyber threats. For central banks facing geopolitical risks and possible sanctions or freezes, this is critical. Shall learn Western dollar assets can be frozen. China knows if trillion-dollar treasuries are vulnerable amid Taiwan tensions. Yet physical gold in Beijing is untouchable by the U.S. Gold is the ultimate haven, not for price gains, but for security and sovereignty. This second, gold's global acceptance is unmatched. If India trades with Iran, but Iran declines rupees, gold becomes the medium, the universal reserve asset overcoming politics. This enduring trust explains its role as money for 5,000 years, driving central banks to return to gold amid uncertain monetary futures and shifting geopolitical ties. Gold's trust and acceptance as universal money persist. Amid increasing digital currencies and persistent cyber threats, central banks understand digital asset vulnerabilities. North Korean hackers stole $600 million in crypto, highlighting digital asset susceptibility to hacks. Conversely, physical gold in fortified vaults with multi-layer security requires a far more complex breach. Central banks buy gold to prepare for a world of relentless cyber threats where digital assets are perpetually targeted, offering analog security in a digital age. 4. Gold's inflation resilience is a central attraction. Bonds suffer under inflation with negative real yields. The 1970s saw nominally flat inflation-adjusted stocks drop 50%. Yet gold surged from 35 to 850 per ounce, a 24x return amid inflation. Gold protects and multiplies wealth during inflationary periods. Central bank foresee 1970s-like inflation, exacerbated by higher debt levels and extreme money printing, and favor gold for its inflation-proof properties. Like those of central banks with trillion-dollar budgets and skilled economists, timing is crucial when aligning with institutional and retail phases. Central bank purchases usually signal a move made 5 years prior, so you might be late for the bottom. 2020, or it reached 2,700, a 50% point increase. Following central bank moves can yield significant benefits. Buying now at 2,700 could set you up for a 7-4x return by 2027 if revaluation occurs. Assuming central banks' superior access to intelligence and geopolitical insights, a safe historical bet to follow. Central banks don't whimsically spend $86 billion annually. They position based on intelligence not publicly available. Historically, the following the lead proves wise. And understanding the 3 capital flight phases is crucial for smart positioning. Phase 1 belongs to smart money central banks, sovereign funds, billionaires, family offices quietly accumulating assets. Phase 2 sees institutional money hedge funds, pensions, asset managers moving in as trends become clear. Central banks, 3,000 ton purchase over 3 years draws institutional attention, prompting analysts and managers to enter the market. We're transitioning into this institutional phase now, with hedge fund advocates like Ray Dalio and Paul Tudor Jones endorsing gold allocations. When institutions speak, allocations follow. This phase could take gold from 2,700 to 6,000. Yee! Having watched gold ascend from 2,700 to 6,000, understood. With mainstream media capturing daily highs and market frenzy peaking as gold reaches 20,000. Between smart and institutional money, retail remains largely oblivious. Only institutional positioning, pre-phase 3, is where you should be. Invest 10 to 20% of your liquid net worth in gold. Hey! Now one of the 10,000 to 20,000 for a 100,000 portfolio. 70% in physical gold and altcoins, reputable bar stores securely at home or in a private vault. Prioritize bullion, 20% in gold ETFs like GLD. Gold in retirement accounts where physical isn't viable, while acknowledging their counterparty risk. ETFs might face failure or government confiscation, yet remain optimal for retirement holdings. 10% in mining stocks, ferric, wheat and precious metals for leveraged exposure. Stocks offer higher returns if gold prices rise but come with volatility and operational risks. This allocation serves your speculative position for potential upside. The threat of government gold confiscation like in 1933 seems unlikely now. Then, the dollar was dollar-backed, requiring accumulation for buying. Confiscation offers the government legal only 2% of Americans own a physical gold. Enforcement difficulties and international gold trade make modern confiscation impractical. More probable is governmental revaluation, benefiting private gold holders as market prices adjust. Gold's lack of dividends or interest consider a diversification. During monetary upheavals, income-generating assets often falter. Bonds default or inflate, stocks lose dividends or bankruptcies rise, and real estate turns illiquid. Gold, while not yielding income, sidesteps these risks, balancing opportunity costs with protection. Its capital appreciation potential rising from 2,700 to 20,000 surpasses many income sources. Central banks prefer gold for proven resilience through crises, choosing reliability over potential high returns. Bitcoin's future amid regulatory challenges is uncertain. Should Bitcoin be a part of your speculative portfolio? Perhaps, but a minor part given its speculative nature. Or protection against dollar failure likely lies in gold. As central banks focusing on gold indicate, open account with reputable dealers and research options. Begin purchasing physical gold within a month. Implement dollar cost averaging, purchasing monthly, staying the course until mid-2025. As gold reaches milestones, 3,000 to 4,000 barking phase transition position fully by 2027 fully, but anticipate revaluation. Ultimately, this strategy preserves wealth amidst widespread dollar losses, aligning with central banks' foresight. The Bank for International Settlements highlighted geopolitical concerns, and system changes driving gold demand in acknowledgement of the inevitable. Aye! Central banks are purchasing gold at volumes unseen in 73 years, but preparing for a dollar collapse and monetary reset. Question isn't if it will happen, but whether you will prepare in time. Aye! Central banks have interpreted the sign and acted. Follow their lead or risk financial oblivion. Choose wisely as the window for action narrows.